Hey, Mr. Chair, and thanks to the witnesses for hanging in there. I know it's been kind of a long morning. Mr. Newell, you've seen firsthand how the regulatory burdens, and I know you spoke about this earlier, do the compliance costs and disclosure requirements push companies to seek alternative paths like mergers, private funding, or even overseas markets?
The compliance costs of going public are substantial. I think we've talked about it today. I know we spent about $5 million in accounting just to satisfy the accounting requirements to go public. So when you know that money is going to go out of pocket with no real benefit to you and your business, you naturally think about alternative strategies to finance the company and move it forward. And the ones that you've suggested are things that happen. There's a process called a dual track process that exists where oftentimes companies will look to either raise capital through an initial public offering or at the same time look to sell or merge their company into another company. And that's because they don't necessarily want the burdensome consequences of going public and may be able to actually continue their journey as a company, but in a different fashion.
So do you think if Congress extended kind of the on-ramp period, what changes would be necessary to ensure kind of that the companies themselves not only go public, but also kind of thrive in the public markets
I think
long term?
Yeah. Thank you, Congressman, for that question. I think it's important that we have ways in which not only companies avoid excessive costs that really do not contribute to the growth of the company and are not necessary for investor protections, but then look at ways in which we can expand the access to capital to those companies. Oftentimes, just because you go public, it doesn't mean you've got all the capital in the world that you need. And so you continually have to look for new sources of capital. That's certainly very true in our biotechnology industry. You need to keep going back and finding new investors, and that means any limitation on who can invest, the amounts they can invest, all of that is a barrier to your being able to continue and succeed with your business.
Very good, thank you. Mr. Case, expanding and diversifying the pool of individuals who qualify as accredited investors, as we know, is essential to unlocking new funding opportunities especially for entrepreneurs, right? And founders in really companies, small companies across the whole nation. So some of those current regulations, as has been discussed this morning and this afternoon, still pose significant challenges. I mean, that's why we're here today, I think. How do current regulations around accredited investors create barriers for both the investors and the entrepreneurs? And I know you've discussed this again earlier, but what are some of the reforms that would help expand access to capital while maintaining the protections that investors are looking for?
Obviously, we have to strike the right balance, giving people the opportunity to invest, but in a way that is safe and makes sense. But it goes back to what I said before, and probably should have emphasized it more earlier. There's sort of been a structural change in the capital markets in the last several decades. And in my era, when companies like my company, AOL, was going public, but also when Microsoft was going public and Amazon was going public and many other companies were going public in the 1990s, they generally raised capital much earlier in the cycle. All of those, for example, the valuations at the time were in the few $100 million range. Now, nobody goes public until there are many billions of dollars of valuation. What that essentially means is those retail investors who believed in Microsoft or believed in Amazon and were able to get in kind of on the ground floor, not at the first venture capital level, but kind of on the ground floor, were able to see the benefit of that, and it benefited their families in terms of the appreciation of wealth. That's largely been taken away because companies are not going public until it's much later, and that's not entirely because of regulation. Some companies choose not to go public because they want to take a longer-term attitude, but most of it is because they have access to capital now to grow without going public, which is different than 3 decades ago, and they're just worried about the costs and complexities of being public. As a result, the individual investors are being deprived of the opportunity to participate in some of that upside, modifying the accredited investor rule so they can invest in these high-growth companies when they are private would be a step in the right direction.
Very good. Thank you very much. I yield back.